Roku is down almost 90% from its high. So the question is now the time to buy the stock? That's what we're going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and it's been a huge roller coaster for Roku as a company. Their shares went up as much as $500 per share, and now they're back down 90% to around $50 per share. And if you're not sort of familiar with the story, let's start with this. You can see here that back in 2018, Roku was trading around $50 per share, and then they went through the COVID surge and went up to approximately $500 per share. A lot of people like Kathy Woods said that the stock was worth a lot more at the time. I remember I started looking at it at around 2021. I was very late to the party. Like, I was aware of Roku, but I just never really looked at the stock. But I just didn't see the opportunity here. The financials didn't make sense, and so I just sort of walked away from it. But the model has been in the tracker that the Patreons have had access to for a long time. Roku was similar to like Shopify, where I did value the names, but it didn't make any sense to me at all. And so we just never bought it. And so now it's like of no surprise that the share has come down 90% from its peak. It was just way too expensive at the time. And so if you really liked that opportunity, you really would have had to buy into the story and not look at the financials. And I personally just can't do that. But I have lost out on opportunities in the past because I can't do that. But that's okay, because I rather invest in what's considered sort of like an inevitability, like it's inevitably going to happen. And even just doing that and being conservative, I tend to make mistakes every now and then. And so a story type of investment is not really one for me. But what does the market think about Roku now that it's down 90% from its peak? Well, you can see here that analysts seem to be pretty positive on the company. So Seeking Alpha authors have a buy rating on the name, and Wall Street also has a buy rating on the name. Now let's dive into this a little bit more and see exactly what they're saying. And so you can see that it's split pretty evenly between the strong buys and the holds. But of course, there's 14 buys and strong buys combined, and there's 10 holds. So it's not really a huge consensus, which is what I would expect for this name. But the thing that I really like to focus you guys on whenever you look at analyst expectations or analyst buys and sells is not actually the buy rating that Wall Street provides, but instead what I'd encourage you guys to focus on is the price target. Because if the price target is not more than 50% greater than the current share price, the analyst community is not really that big on it. And just recall, guys, that I used to be in the sell side. And another thing that I want you guys to notice is notice how the analysts have brought their price targets down in relation to the current share price trading lower as well. And so that's why I say never really trust the buy target as a whole. Once again, pay attention if the average price target is greater than 50% of the current share price. And in this situation, it's only 14.7% of an upside baked in by the analyst. That doesn't sound like an optimistic valuation from my perspective. Now, let's take a look at the operations of the company. Well, you can see here that I was actually expecting a higher gross margin in fiscal year 2022. Recall that I was doing the valuation for this company in 2021. And the gross margin that I expected in fiscal year 2022 was much higher than 50%, getting closer to that 60% range. And so, of course, they've gone backwards. And it's not really their fault that they're going backwards. It really speaks to how fast the economy has deteriorated in this environment with the rate increases that we're seeing, which, of course, has impacted advertising spend, which Roku is a major recipient of with their business model. And so you're seeing it here in their financials, in their gross margins, that the economy is deteriorating and ad spend is declining. And so, of course, their adjusted EBITDA is now in the negatives as you're seeing over the last 2 quarters. And remember, in the first 3 quarters, their gross margin is around 45-ish%. Notice what they're forecasting for the 4th quarter. They're forecasting a 40% gross profit margin. And so they're forecasting a further material deterioration in the business. And most people are calling for a recession in 2023, not so much in 2022. And so if you're going to have a further deterioration to the economy in fiscal year 2023, where do you think these gross profit margins are going to go? And so you could see serious pain in fiscal year 2023, which could create somewhat of a buying opportunity for this name. Now, I'm going to show you what the valuation is right now, and I'll show you sort of like, or I'll let you know what I'm sort of thinking about, because ultimately, I do love the company. I love what they do. And I do believe that this is a future-focused company that doesn't care which streaming service wins. They're going to sell all of them on their platform. And so let's dive into that a little bit more. So you can see here that they're continuing to invest in their platform. And I actually bought a Roku device just to sort of like test it out. I really like it. I just don't like commercials on TV, but that's okay. I would get all of my subscription streaming services through this device if I didn't already have a smart TV or just had it on the app. But, you know, to each their own how they want to sort of access these devices. I like the ability of accessing a device using a converter than my phone, but that's just me. I'm also like ancient. And so notice that they continue to add streaming services. So recently in this past quarter, they added Paramount Plus, and they're offering this subscription service on their channel. And so this is where Cathie Woods got it right. The major investment thesis for Roku is that they do not care which streamer service wins. They will sell all of them on their platform. And so for a lot of people, having access just to their Roku device, and they have all of their streaming services lined up, as well as all of like their free channels that they like to tune into also lined up in an easy to see place, is really valuable. And so this is where Roku provides a very valuable service. And so I do believe that they're going to continue to grow. Look, the usage on the platform is growing every quarter. That's not stopping. What this all comes down to is, what does the valuation look like relative to the cash flows that this company is generating? And notice that they're looking at the economy the same way that I'm sort of looking at it. They expect the macro environment to further decline, and which is expected to degrade advertising budgets, especially in the TV scatter market. And so they've actually taken steps to significantly slow the rate of hiring. And of course, they're probably finding other ways to protect their profit margins, but they're still being conservative and forecasting a 40% gross profit margin in the fourth quarter. And I do believe that if they do provide a full year 2023 guidance next quarter, they will probably expect a 40% gross profit margin or lower. So the question is, if we're entering into this deteriorating economy, do the companies that we're investing in have the balance sheet to weather any potential storm, especially a company like Roku that's still running losses, or especially now that they're running a negative adjusted EBITDA as the economy starts to deteriorate? Well, you can see that their balance sheet remains strong. They still have approximately $2 billion of excess capital, and they should be able to emerge from a prolonged downturn in the economy. Notice that the only long-term debt that they have is $82 million, and they have zero long-term debt on the non-current side. And so they are very well positioned to survive a prolonged and brutal recession, which I don't think some companies that people are very excited about today will be able to survive through. And now here's their historical income statements. Now, the point that I want to make here is that if you used the historical actuals to forecast out revenue growth, you would have overvalued the name, in my opinion. And so the reason why Cathie Woods gets to like a $1,000 per share valuation for Roku is because she's pushing out these revenue growth rates, and she's pushing out these gross profit margins. And you can see in 2021 that their gross profit margin of 51% is why I expected a gross profit margin of 50% in 2022. And of course, they went backwards. And now in the fourth quarter of 2022, and I would think beyond into 2023, they're probably going to achieve gross profit margins similar to what they achieved in 2017. But don't be surprised if the gross profit margins decline to 30 or less in 2023. And so what that would mean is that they would be having huge operating profit losses. Remember, they were losing close to $40 million a year in 2015 and 2016. Well, in 2016, they actually went over $40 million. But could you see them losing $50 million a year in maybe 2023 and maybe even 2024 if the recession is prolonged? It could happen. But when you got $2 billion of cash on your balance sheet, you're fine. And so with that, we know the company's going to be around. And so we could forecast out the valuation. So notice I'm being a little bit pessimistic on the revenue growth rate. I expect them to grow at around 12.5% in 2022. In 2023, I might be a little bit more optimistic here, but I expect that growth rate to return back to 15% on the top line. They might sacrifice profitability to get there, and I think that might actually happen. But you guys can reverse this. You could actually reduce the revenue, increase the gross profit, or just reverse the revenue as a whole and just grow it at 10% in 2023, and then bring it back up in 2024. I think over the time period of 2023 to 2026, I think it averages around 15%. So this is why I'm okay with this valuation. And then in 2027 and thereafter, I expect revenue to slow down a little bit and grow at approximately 10% a year. Now, as you can see, I could be very pessimistic on the revenue growth rate. I just don't know how to forecast it out. But some of you guys might look at the 2023 number and say, hey, that might be too optimistic. Let me know in the comments what you think. Now, with the gross profit, notice I'm actually forecasting lower gross profit in fiscal year 2023 at 40%. And then in 2024, I expect it to recover a bit. And over time, management has told us that they expect the business to be a 60% gross profit business. And so by 27, I do expect that to happen. Now, SG&A as a percentage of revenue, I do expect by 2024 that will decline to 23%. And the R&D is also expected to decline to 18% from 20% in 2022. And so in other words, in 2024, it'll just be a more profitable business overall. But notice that the operating profit margin as a whole in 2024 is expected to just be 4%. And I'm forecasting negative operating profit margins in 2023 and in 2022. So you can see the pessimism built into the profitability. But as time goes on, notice that I'm increasing it from 4% to 9% in 2025, and then all the way up to 19% in 2031. And so I do believe that as time goes on, this business becomes more profitable and sort of tops out at that 19%. You guys let me know what you think. This is sort of like the whole pull into these tech names, right? It's losses, 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 and then boom, explosion into profitability. And that's kind of what we've seen with other tech names in these big idea spaces. I do expect to see that with Roku. And so what the real important point here is, now that we can forecast that out, what does this mean to the bottom line in terms of how does this materialize into the valuation? And so here you can see me forecasting out their free cash flow. Now, I think it's very important for you to get access to the model at this point, and you can get access to the model of Roku and all the other companies that I value at that lower tier of the Patreon, which is just $5 a month, which is essentially just buying me a couple of coffees every month to get access to all of my research that I do on all of the companies that I'm following. But the one thing that I do want to focus you guys in on, especially as it comes to forecasting out a company using the free cash flow per share valuation, is if you're going to use a free cash flow valuation, you have to take a position on what stock-based compensation is expected to be in the future and subtract that amount from the expected free cash flow every year. If that doesn't make sense to you, join us on our monthly calls. I break this down all the time, and you will become more of an expert when it comes to modeling companies as a result of joining us on those calls. And so what that will do is it'll give you a net free cash flow. And the reason why you look for a net free cash flow is because the net part, that like amount that you subtract, is an estimation of the cash needed to offset the shareholder dilution of management compensation, because they effectively increase the number of shares trading on the market. And so I forecast a declining amount of stock-based compensation as a percentage of revenue into the future. Notice at the bottom here that stock-based compensation as a percentage of revenue in 2021 is 6.8%. In 2022, I forecasted it to be around 7%. And then I decline it by 0.5% into 2026, and then I'm essentially just forecasting it at 5% thereafter. Overall, this is a low amount of stock-based compensation as a percentage of revenue, and it could actually tick upwards as the company achieves higher profitability. I really hope it doesn't, because it would blow up the valuation, but it absolutely could. You guys let me know what you think. But I haven't seen any other finance YouTubers talking about this concept, and so I really sort of like question their level of experience as it comes out to modeling companies using a net free cash flow per share valuation methodology, because if you don't include that stock-based compensation, you are overvaluing what the company is worth to the owners, because the owners don't actually get that level of cash. Even if the company is buying back shares with all of that cash, part of those buybacks are buying back shares that they issued to management. So that's not really cash that we get. So it doesn't make sense to not include this when you do a cash flow based free cash flow valuation. But it is something that I've seen a lot of YouTubers do in this space, and it's kind of crazy to me if you ask me that they're not including this. And so it's just weird. And so I just wanted to point that out because once again, I'm not seeing anyone talk about it, but it's so just like basic level finance valuation type stuff that I really feel that people should be aware of. And it's stuff that I'll just give away for free on the channel because I rather you guys be better investors and make better investment decisions than hide this kind of information behind a paywall. Now, I do want to take you guys into the valuation, but before I do that, I just want to remind you guys that approximately 80% of the watch time on this channel is coming from people that are not subscribed. So if you haven't done so, please hit that red subscribe button. Now, you can see here, this is my FCF PS valuation, free cash flow per share valuation, which is a net free cash flow per share valuation. We just talked about why it's a net. And notice I'm using a multiple of 20 times earnings. And so I'm valuing the company at approximately $32 per share based on their earnings profile. They have $2 billion of excess capital, which increases their valuation by $14.60 per share to $46.50 per share. Now, the current share price is $54 per share. And so it's actually trading at a slight premium to its current valuation. But recall, guys, that my valuation might be underestimating their revenue growth into the future. And so if you are forecasting higher revenue growth and higher operating profit margin, especially 5 years out, you're going to get to a much different valuation. But essentially what I'm saying here is if it's not inevitable, I don't care for it. And I'm not rushing to buy Roku in this environment. You guys let me know what you're valuing Roku at, and let me know if this is an opportunity for you or not. Now, a company that's a little bit easier to value from my perspective, and it's more of an inevitability, is H&R Block. And I recently did put out a video on it. I think it's a very important video. So if you haven't seen that video on H&R Block, click on this link right here.